Hi everyone, today we'll be going over accounts, February-March 2021, paper 2 question number 2. This is structured paper 2 which consists 4 questions, 2 of 30 marks and 2 of 15 marks, and we are also given a time limit of 1 hour 30 minutes. Since question number 2 is of 15 marks, we will be attempting to solve this question under 15 minutes. So without any further delay, let's get started. Myra owns a delivery business and the following information is available about her business's delivery vehicles. So she has 3 vehicles, A, B, and C, and we're given the date of purchase as well as the cost for each of these vehicles. Then we're also told that vehicles are depreciated using the straight line method at 20% per annum, and depreciation is charged on a month-by-month basis, which means that the depreciation per each month will be same because we are depreciating using the straight line method. And the business's financial year end is 31st December. Now for the first part of this question, we need to calculate the balance on the provision for depreciation of vehicles account at 31st December 2019. Okay, so let's create a statement. So we need to figure out the provision for depreciation for vehicle A, vehicle B, as well as vehicle C. Okay, now I'm going to prepare a timeline because it is easier to understand the time frame doing so. So we need to figure out the provision at the end of the year 2019, right? So this is 2019 and we use the vehicle for entire 12 months, right? Then this is the year 2018. Again, we use the vehicle for entire 12 months and this is the year 2017. And we are told that the date of purchase for vehicle A is 1st August 2017. So we bought it right here on 1st August 2017, which means that the number of months that we use this vehicle in the year 2017 would be August, September, October, November, and December, which is 5 months, right? So the total number of months that we used our vehicle A would be 5 plus 12 plus 12, which results in the value of 29. So we used vehicle A for 29 months and we're going to figure out the total depreciation for these 29 months, which will act as our provision for depreciation. Let's do that. Since we know that the depreciation method is a straight line, we can just multiply our rate of depreciation to the cost, which in this case will be 30,000 times 0.20, which is 20%. But remember that this will give the depreciation charge for 12 months, but we require our monthly depreciation so that we can multiply it by our number of months, which is 29. And in order to figure out the monthly depreciation, we just need to divide it by 12 because if this is the charge for 12 months, then dividing it by 12 will get us the charge for 1 month. Then we can multiply it with the total number of months, that's 29. So times 29. And this gives the provision for depreciation for vehicle A to have the amount of 30,000 times 0.20 times 29 divided by 12, which is 14,500. Now we repeat the same process for vehicle B. Let's create a timeline. And its date of purchase is 1st February 2018. So if this is the year 2018, the vehicle was purchased right here. And we purchased it on February, which means that the total number of months in 2018 where we used vehicle B would be 11 months. And then for 2019, we used it for the entire year, which is 12 months. So the total number of months in which the vehicle B was in use would be 11 plus 12, which is 23. Alright, now we just need to figure out the monthly depreciation and then multiply it with 23. We'll start with our cost of 36,000. So that's 36,000 times the rate of depreciation of 20. And this gives the annual depreciation, which relates to 12 months. But we only require the depreciation charge for 1 month. So we're just going to divide it by 12 and then multiply it with the number of months where we used vehicle B, which we just figured out to be 23. And this gives the provision for depreciation for vehicle B to be 36,000 times 0.20 times 23 divided by 12, which is 13,800. Now we repeat the same process for vehicle C. Let's create a timeline. And it was purchased on 1 June 2019. So this is the year 2019 and it was purchased on 1st June. So the number of months where you use vehicle C would be June, July, August, September, October, November, December. And that's 7 months. So we use vehicle C for the total of 7 months. Now we just need to figure out the monthly depreciation and multiply it by 7. We'll start with our cost of 39,000. So that's 39,000 times 0.20, which gives us the depreciation of 12 months, but we only require the monthly depreciation. So we just divide it by 12 times the number of months where you used vehicle C, which you just figured out to be 7. And this gives the provision for depreciation for vehicle C to be 39,000 times 0.20 times 7 by 12, which results in the value of 4,550. And we are required to figure out the total balance on the provision for depreciation of vehicles account. So that's going to be the total of these three amounts: 14,500 plus 13,800 plus 4,550, which results in the value of 32,850. And this is our total provision for depreciation. All right, this concludes the first part of this question. Now we can move towards the second one. We are now given additional information. On 1st March 2020, vehicle A was sold in part exchange for vehicle D. Vehicle D cost 42,000, of which 29,200 was paid by check. So the remaining was paid by the part exchange. So let's figure out the part exchange value. That's the difference between the cost of vehicle D and the check payment. So that's 42,000 minus the check payment of 29,200, which gives the value of the part exchange to be 12,800. Alright, now for the second part of this question, we need to prepare the vehicle disposal account. And whenever we are trying to figure out the non-current assets disposal account, whatever non-current assets is being disposed, its cost is to be recorded on the debit side, right? And right here we are disposing vehicle A. So we need to record vehicles A cost on this debit side. Let's write it down. So that's vehicle A cost, which was given above. Let's have a look. And the cost for vehicle A was 30,000. Let's record this. And we also need to record the provision for depreciation of the disposed non-current asset on the credit side of the disposal account. Let's write it down. Provision for depreciation of vehicle A. But remember that we need the provision for depreciation on the date of 1st March 2020, right? And previously we already figured out the provision for depreciation at 31st December 2019. So we'll start with this value of 14,500. So this is the provision for depreciation. And we have the value of 14,500 for the date of 31st December 2019. And the date from December to 1st March, the number of months that vehicle A was used would be January, February, and March, it's the first date. So we have not used the vehicle for the entire month of March. So the only number of months in which you used vehicle A before part exchanging it would be January and February, which is 2 months. So we also need to add the 2 months depreciation to our provision for depreciation. And we know that the cost was 30,000. And the depreciation rate was 20%, so that's times 0.20, and this would give the depreciation of 12 months, but we only require the depreciation of 2 months, so we can just multiply by 2 and divide by 12. Alright, so this gives the total provision for depreciation to be recorded on the disposal account to have the value of 14,500 plus 30,000 times 0.20 times 2 by 12, which results in the value of 15,500. Let's record this value in our disposal account. Okay, then the next step would be to record the value at which the vehicle or non-current asset is being disposed. In this case, we are part exchanging it, right? And the part exchange value, we just figured it out to be 12,800. And this part exchange or the disposed value is always to be recorded on the credit side. Let's record it. So that's the part exchange value of 12,800. And now we need to figure out the profit or loss on disposal. And in order to do so, we first require to figure out the heavier side. Obviously, 30,000 is greater than the sum of these two values, so the heavier side is going to be the debit side. So that's the total of 30,000 and 30,000. And we can see that the cost is greater than the provision for depreciation and part exchange, which means that there is a loss, right? And this loss is to be recorded on the income statement. So that would be income statement. And this now acts as our balancing figure. And in order to figure the value of the loss to be recorded on the income statement, we just need to subtract these values from the total. That's 30,000 minus 15,500 minus 12,800, which results in the loss on the disposal of vehicle A to be 1,700. Alright, this concludes the vehicle disposal account. Now we can move towards the third part. We now need to prepare the provision for depreciation of vehicles account for the year ended 31st December 2020. And we first require the provision for depreciation of vehicles value at the date of 31st December 2019, which will act as our opening balance, right? And the opening balance of this depreciation will always be recorded on the credit side of provision for depreciation account. So that's balance BD. And remember that this is the opening balance, which means that this is the provision for depreciation value at 31st December 2019, which we already figured out in the first part of this question. So we're just going to substitute that value. Let's have a look above. So the total provision for depreciation was 32,850. We're just going to substitute this value as our opening balance in the provision for depreciation account. Alright, so that's 32,850. And we also disposed vehicle A, right? So we need to subtract that disposed vehicle's provision for depreciation, which means that whatever disposal provision for depreciation there is, that would be recorded on the debit side. So we could write it under the heading of disposal. And we already figured out the disposed vehicle's provision for depreciation while creating its disposal account above. Let's have a look. So we recorded the provision for depreciation right here, and its value was 15,500. So we just need to subtract this value from our total provision for depreciation now, which is why we are recording its value on the debit side. Let's write it down. So that's 15,500. And the next step would be to add this year's depreciation charge. And we know that the depreciation charge is recorded on the income statement, and this is to be added. So obviously this needs to be recorded on the credit side under the heading of income statement. Okay, so we need to figure out the depreciation charge for this year. Now, we know that vehicle A was used for the month of January and February, right? So let's figure out the total depreciation charge. For vehicle A, that's going to be the cost of 30,000 times the depreciation rate of 20%. And we only used it for 2 months, so that's 2 by 12, which gives the depreciation charge for vehicle A for this year to be 1,000. Now we repeat the same process for vehicle B. Let's have a look above for its cost. And the cost was 36,000. So let's utilize this value. That's going to be 36,000 times 0.20, which gives the depreciation charge for entire 12 months, which is what we require. So this gives the depreciation charge for 12 months on vehicle B to be 7,200. Now we repeat the same process for vehicle C. Let's have a look above. And the cost is 39,000. So we're going to utilize this value. That's 39,000 times the rate of 20%, which gives the depreciation charge for 12 months, which is what we require. So the total depreciation would be 39,000 times 0.20, which results in the value of 7,800. And we also purchased a new vehicle D, right? So we need to charge its depreciation as well. And we know that vehicle D was purchased on the date of 1st March 2020. So the number of months in which we used our vehicle D would be March, April, May, June, July, August, September, October, November, and December, right? Which is 10 months. So we need to charge the depreciation on vehicle D for 10 months. Now let's have a look above for its cost. And we know that vehicle D cost 42,000. So we'll utilize this value. That's going to be 42,000 times the depreciation rate of 20%. This gives the depreciation charge for 12 months, but we know that vehicle D was used only for 10 months. So that's going to be times 10 by 12, which gives the required depreciation charge on vehicle D to have the value of 7,000. Now let's figure out the total depreciation. That's going to be the sum of these four values. So that's 1,000 plus 7,200 plus 7,800 plus 7,000, which results in the total depreciation charge for the year to be 1,000 plus 7,200 plus 7,800 plus 7,000, which is 23,000. And we need to record this in our provision for depreciation account. So that's going to be 23,000. Now we can easily figure out the closing balance, right? So that's balance CD. And in order to figure out this value, we first require the total. So let's figure out the total from credit side. That's 32,850 plus 23,000, which results in the total to be 55,850. And this total is the same for debit side as well. Now we can easily figure out the closing balance as it acts as the balancing figure. So we need to subtract this value from our total. That's 55,850 minus 15,500, which results in the closing balance of the provision for depreciation to be 40,350. And this closing balance for this year will act as the opening balance for next year. So we need to record it as the opening balance as well on the opposite side. So that's balance BD with the value of 40,350. All right, this concludes the third part of this question. Now we can move towards the fourth one. We are given additional information. Businesses may use the revaluation method of depreciation for some of their non-current assets. So under revaluation method, we do not charge the fixed amount of depreciation. We just revalue the value of the assets. And for the fourth question, we need to explain one reason why some businesses may use the revaluation method of depreciation. Okay, so the revaluation method is used when any non-current asset consists of many items but each of small value, which would make it impractical to calculate the depreciation charge, right? That could be a reason. Let's write it down. The revaluation method is used when a non-current asset consists of many items of small value, making it impractical to calculate a depreciation charge on each item. Alright, this concludes the fourth part of this question. Now we can move towards the fifth one. We need to state how an annual depreciation charge is calculated using the revaluation method. So like I said before, there is no any fixed rate of depreciation. So we just revalue its value. So the depreciation charge is just going to be the opening value minus the closing value. The depreciation charge is calculated by comparing the closing valuation of the non-current asset with the opening valuation. And this concludes the fifth part of this question as well as the entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.